the best way not to pay taxes is to not make any money,
That's right.
right? And if you think about it on a historical basis, tax rates are actually quite low, believe it or not. I mean, they've been far higher in the past.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Well, Jake, thanks for having me. You got the tunes going early this morning. I like it.
I do, and we are recording this from cloudy Kansas City. Now, Cory, I did look at the long-term forecast, and by the time this episode is produced and through our compliance, should be back in the 40s or the 50s. So hopefully that snow is gone in your background there.
We talk a lot about predicting the future on the show, though, Jake. We'll see if that's the way that it plays out. I hope so. I hope you're right.
Yeah, weathermen don't know either, do they? They don't know what's going
Yeah,
on
it's
either.
a tough job.
It is a tough job. It is a tough job. So good. You got anything new for our audience before we kick it off today?
I don't really have too much new, Jake. How about you?
No, yeah, the move into our new home has gone quite well. It was a very cold time of year to do something like that. But like I kept reminding myself and Rachel, we chose this, right? And so we had fun with it. The house is cool. It's going to take a while because we're getting wallpaper put up, and that takes a long time, I guess. So who knew? But anyways,
the process.
I'm going to get wallpaper in, I think, hopefully March, and furniture probably in April. And we've got some of our old stuff, so it's not like we're sleeping on the floor. But I'll be happy once we've got more stuff in there and it's kind of looking more like a home versus an empty house.
I'm excited to come see it. I felt like I had a little bit of FOMO when we got together on New Year's Eve with a few other couples, Jake, and everyone was talking about the house that you and Rachel were moving into, and I'm the only one who hasn't seen it.
Yeah, shame on me. I need to get you over there. Well, maybe you can help.
That soon.
Maybe something will break and you can help come fix it.
There we go.
So we'll do that. And first, foremost, Cory, again, thank you to our audience. Our subscriber count on YouTube, Cory, is almost at 1,000 subscribers, which is very cool.
It is.
Luke, our communications manager, says that that's some kind of major threshold. So we are marching that way. I think we're over 900 now.
Yep.
And thank you to everyone that's tuning in. Also, who's listening to this on Apple, iTunes, or Spotify. Thank you. Please subscribe, 5-star review, like, and share our content. We're doing this whole show to enhance financial literacy. So it's very important to us that our clients get this information. And then, of course, if they think it's any good, that they share it with their network as well. Also, I'm proud to report that we are transcribing our content as well. So if you'd rather read Upticks, you simply just need to go to www.falconwealthadvisors.com under our content section. That's where you can start finding the transcripts of our shows. All right, Cory.
Play ball.
There you go. Let's kick us off. All right. So this is from a listener, and thank you to the listener who sent the article in. The title here, Cory, is The State of Insurance Across the Country. What are we talking about here?
Well, while we are talking about the state of insurance across the country, this was recently published in the Wall Street Journal, and it really just highlighted the challenges around insurance, and more specifically, homeowners and auto insurance, how the process of ultimately securing coverage and shopping coverage is not as routine as it once was, because insurers are coming off of some of their worst years ever, just in terms of losses that they've had, and prices for coverage are all over the place. And ultimately, it would serve people well to shop as appropriate for insurance and not just make the assumption that things are routine and status quo.
Right. And Cory, I don't feel sorry for these insurance professionals because they've made a lot of money for many years. And yeah, when you have a lot of claims, you got to pay out the money. That's the whole point of insurance. And shame on them, Cory, for not doing proper financial planning. Right. So
that's right.
Instead, they're jacking up their rates and making it very expensive, especially for some extreme parts of the country. I think we've talked about this on the show before with
Yep.
Florida. I bet California is expensive. And so you're right. It pays to go to an independent insurance agent, someone who can shop all of the major carriers and get you the best coverage at the best price. That's really what you're looking for here. So thank you again for the listener. You're right. It's a tough deal. Insurance is something that you pretty much should have in most circumstances. I mean, some people have enough money they can self-insure. But again, if you can get it at the right price and get good coverage, it really makes sense. So again, go out there, shop, look at an independent agent, and let's make sure you're getting good coverage at a good price.
Yep, absolutely. Moving on from that, taxes. Jake, I feel like you have a lot of taxes as conversations on the show here recently, but it is pertinent and relevant for all of us. Let's talk about this from some client conversations. What have you got here?
Yeah, so I haven't met a client. I want to hear your take. I haven't met a client, Corey, that wants to pay more taxes. Have you met a client that says that?
Nope.
Right. And you and we were talking about a client situation where they were really upset about their tax bill. And
Mm.
their tax bill is and was very high. And you and we had a private conversation about this, if you remember, and you said the best way not to pay taxes is to not make any money.
That's right.
Right. And if you think about it on a historical basis, tax rates are actually quite low, believe it or not. I mean, they've been far higher in the past. And so I just want our audience and clients and friends and family and whoever's watching or listening to just understand that if you have a high tax bill, one or two things are going on. One, you made a lot of money. Good for you, right? The opposite of that is you make no money and you probably don't pay very many taxes, if any.
Yep.
So normally people are going to go, hey, I'd rather make a lot of money. And the second thing is maybe you're not doing proper tax planning. And again, that's a big service that we offer our clients at Falcon Wealth Advisors is we will take your 2023 tax return, scan it into our third-party software that we pay for, and we'll look at opportunities to lower your taxes. Now, you have to be careful though, because there's not some crazy extreme thing that we're going to recommend you do to make your taxes go to zero, because it's probably towing the line of being legal or illegal. And again, the idea is that you've got to pay taxes if you make money. It's just the way the world works. To have a society, it's the way it happens. And you even commented on people that think, because a lot of people think, Corey, oh, I hear about all Warren Buffett doesn't pay any taxes, or all these rich people don't pay taxes. How come I can't be like them? And when you and I were having this conversation, do you remember what you said?
Yeah, I think I probably said, Jake, that most people are not rich enough to not pay taxes.
Right. So if you think you can get away with paying zero taxes, you've got to typically have hundreds of millions of dollars, many different accounts, irrevocable trusts. You're giving money to charity. You're living off capital gains, right? Or
borrowing
interest.
against your assets.
Borrow. Quick side story. Are you familiar with the Estee Lauder story on this?
I am.
We talked about it. So not to go off on too much of a tangent, but the Estee Lauder family is brilliant. They found a way to do something called a prepaid variable forward on their family stock, their company stock, where they were basically borrowing money against their stock, and then the growth of the stock was paying back the loan. Now, the IRS didn't like this, but what they did was completely legal. And so, again, we're talking about hundreds of millions of dollars here, Corey. And again, those people are in a different zone altogether. But for the normal person, or even the high net worth, or even some of the ultra high net worth that have 25 million or 50 million, you're going to have to pay taxes. That's just the way it works. Let's do good tax planning. Let's understand, let's be thankful, let's be grateful that, hey, I'm in this situation where I made a lot of money. And yeah, I know it sucks. You got to give some of it back to Uncle Sam or Kansas or Missouri. But that's just the way the world works. There's no way getting around it. So let's embrace it, understand it, and move on.
I have a good friend from high school and college, Jake, who works for the IRS and has said that taxes are the cost for a civilized society. And the perspective that we have, like you've outlined here, is we don't want anybody to pay more than they need to. But ultimately, we recognize that we're going to pay our fair share, and that's okay. But let's plan accordingly. And let's ditch the delusion or illusion that we can put ourselves in a situation where we just don't have to pay any money to Uncle Sam.
Right. Because then if you look at it at an extreme example, you're not a productive member of society then. Because you're not contributing.
Right.
So shame on you. Just
On
kidding.
me. No, I'm just
Not
kidding.
you, not you, not
I
you.
know I'm
Shame on the
teasing.
person that wants to pay no taxes. It's like, okay, then our roads will cripple and our sewers will back up and our schools will, fail. And I get it. I don't want this to turn too political. I get it that
Yeah.
there's a huge argument that the government mismanages the money, and I actually agree with that. I think they do, but what are you going to do, right? It's like your friend said. Of course, they said that they're in the IRS, but it's the cost to be in a society. You got to pay it. Let's do good tax planning. Let's, like you said, I like that, Corey. Let's not overpay, but let's realize if you make a lot of money, you're going to pay a lot of taxes. Just the way that it works.
And I still think that's better than anarchy.
Yes. Yeah, I agree. Yes, 100%.
All right.
All right, good. Let's kick it off into our headlines.
All right. So with our headlines, Jake, how to lower your tax bill with charitable donation deductions.
I read a lot about taxes, as you can see, Corey.
You do.
So this is a good one because the point here is if you are charitably inclined and you are not able to benefit from itemizing your taxes, because, again, with the Tax Cut and Jobs Act, the standard deductions for people, Corey, went very high. And so many people that used to itemize, they would write off their charitable donations. Well, now they can't do that because they don't give enough to put them over this itemized ability.
Threshold.
Right, threshold. So quick 3 takeaways, and we can talk about each one of these individually. Our number one are bunching. And bunching, I mean by maybe you give your church or your favorite charity $30,000 as a one big time. Maybe they have a campaign, Corey, and they're building a new, they're building something, or they're starting a new service, or they're helping, people in a third world country and they really need a real push. Maybe you give them 30,000 and you don't give them anything for 5 years. You say, hey, I want to make this very clear. I'm going to write you guys a check for $30,000. But I don't expect anything else from me for 5 years. Hopefully this helps you out because you're getting the money up front and you're getting it now. And then you're able to potentially write some of that off of your taxes. Again, you want to run this by your CPA. This would be opposed to, Corey, giving them $5,000 a year for 6 years, which potentially could keep you under that standard deduction threshold, and you don't get to claim any of it. So that's one idea. Do you have any thoughts on that?
Yeah, so the bunching piece is ultimately taking multiple years of charitable contributions and making them all at once. I do think something that's pertinent and relevant for this strategy, and Jake, I'm sure you've talked with clients about it the same way that I have, is this might be something that clients exercise like literally every 5 years. They may not do this each and every year, but it's ultimately a way that is intended to reduce what goes to Uncle Sam and increase what goes to charitable organizations.
Right, exactly. The second option, Corey, are donor advised funds. We do a lot of work with donor advised funds. So this would be a similar idea. Instead of though giving it the 30,000 all to a charity, perhaps you put 30,000 in this donor advised fund and you don't know who you want to give that money to yet. You want to earmark that for charity at some point in the future. Well, now because you're donating it to a fund that you advise on, literally the name of it, donor advised fund. Well, now you can potentially take a deduction from this donation, but then wait to give it out. So again, there are certain rules and regulations and stipulations that I'm not going to get into for today's show, but that is another type of an account. You can think of like an IRA, Roth IRA, health savings account. You can have a donor advised fund that you advise and oversee. But again, this is a charitable account that you can help contribute to, invest the money, and eventually give to the charity of your choosing, as long as it's a 501c3 and stipulations are met. Anything in there?
Excellent. I think that one item of note that's pertinent there with the donor advised fund is that people can contribute appreciated stock. So if somebody has appreciated shares of whether it's a company that they invested or they bought shares 20 or 30 years ago, if it's a company stock that they've accumulated a number of shares in and their cost basis is low, this can be a way. Ultimately, making contributions to the donor advised fund using those shares can be a way to avoid paying the capital gains and to help your tax situation the year you make the gift.
Right. And the last one real quick is if you're 70 and a half or older and you have an IRA, you may be able to give money directly from your IRA directly to the charity, and that doesn't count as ordinary income. Now, you don't necessarily get to write it off. However, you are pulling money from an account that is supposed to be taxed, and you're not paying taxes on it, and you're diverting that money directly to a charity. So again, a good one for our clients that are typically retired in their 70s or older, a way to lower some of that IRA balance and still give money to charity without having to pay taxes on the
And the beauty of that, Jake, is it doesn't matter if you take the standard deduction or itemize.
Yes. Yes. Good one. All right. That's enough for taxes for now. We'll see if
All
another
right,
one pops
let's
up
move
here. Cool.
on.
All right, Cory. 6 things I wish someone had told me before I retired. Another list here. Let's hear it.
Yes, this was in Kiplinger actually, and it was written by someone who recently retired, who was a retired journalist who had a 45-year career in journalism. And they pointed out 6 items that they wish someone had told them. And let's just talk about these one by one, Jake. The first one is don't borrow from your 401k. And the author of this article highlighted really that unless you repay that money quickly, if you're borrowing against your retirement account, there's less money that is invested in working for you and compounding and earning investment returns. I don't know if
Yeah,
you
you hate to see that. I've met with hundreds of clients, Cory, over the years, and occasionally someone will come in and they have
sure.
a loan against their 401k as they're approaching retirement. And it's okay. Like you said, you don't want to do it if you can avoid it. However, that person's typically their financial plan isn't as healthy because they either have to default on their loan, they have to pay it back, and then they've lost out on this potential compounding of their money. And I don't like this, Cory. Did you know? And you probably do. I think it's the IRS added a new feature that now you can use a 401k as almost a savings account and borrow
Yes.
against that. So I don't like that, Cory, because they're encouraging people to borrow against the 401k when that's not the whole idea of why the account was set up. So good one today. Takeaway here or call to action. Let's look at other opportunities, other places to borrow from if you're in a pinch. But don't go to that 401k first.
Absolutely. The second item here is pay down credit card debt before retirement. And the author highlighted here really that it is difficult to pay down debt if you have a fixed income in retirement.
Yes, I mean now it's bad. Interest rates on credit
Interest
cards
rates.
15, 20%. And if you're retired, Cory, with $1 million and you're paying interest on a $10 or $20,000 credit card at 15 or 20%, we got to get that cleaned up. So again, don't just be mindful of what interest you're paying and let's zap those credit cards. And the key though, here's the hardest part. If you pay off that credit card, you don't want to rack up that debt again because now you're just doing this horrible snowball and you just keep putting yourself
It's a doom
behind.
loop. Yeah, you don't
Yeah,
want to get
this
into that
doom
one.
loop. I like that. Doom loop. Don't do it.
It is. All
Good.
right. And keep in mind, again, all of this is, I do think it's important to just point out that this is coming from someone who recently retired. He said, these are the things that I wish someone told me. It doesn't mean that
Yeah.
everybody's going to be in the situation where
Right,
they're
right,
entering
right.
retirement, so on and
Right.
so forth. So the
Right.
third item here, though, you mentioned this earlier briefly, consider a health savings account. Healthcare becomes more important and more expensive, as we know, as people age. And a well-funded HSA can be a powerful tool in someone's financial plan, given all the tax advantages.
Yes. So clients, a big pet peeve of clients when they retire, Cory, is how expensive health insurance is. This is a great way to plan for that. If you have a high deductible health insurance plan and you're eligible for a health savings account, you should definitely consider contributing to that. Don't use the money while you're working. Use it in retirement. So again, that's a good one. What's next on the list?
Get the lowdown on anywhere you're thinking of moving. So if you're considering relocating, and really the author here was just saying, know what you're getting into before you settle on a destination and evaluate what you might be missing or ultimately what trade-offs are going to be involved, especially if you're going to move to another state, if you're going to move somewhere else. Really try to look at the big picture before you just make that choice or decision.
Yeah, coming from a guy who just crossed the state line, Cory, from Kansas to Missouri.
That's right.
Again, I understood that because people in Kansas City do understand the different taxes and laws because it's something that we all deal with. But you're right. That's a good one. You want to be aware and don't just flock to Florida because there's no state income taxes. Florida's a great state, but you have to weigh the pros and cons, the cost of living, your community, your social network, all that stuff. You got to look into that if you're going to relocate. It's not easy though. That's a hard one. It's a really hard one to move in retirement, in my
It
opinion.
is. I think it's a great point they made, though. It is very useful in that regard.
Yep.
Point number 5 here, don't assume that everyone will have time for you. Plans and schedules don't disappear in retirement. Factor that in if a goal of yours is to spend more time with loved ones in retirement.
Isn't that sad? It's a truth though. It's sad that we don't always make time for our loved ones and especially our clients that retire young because a lot of their friends are still working, right? So we have clients that retire in their early 50s and now they're kind of out on their own and their peer group is all still punching the clock. And so just be mindful of that other people have priorities and goals and things going on in their life. So you want to make sure that you've allocated time, and basically that you're able to entertain yourself, I guess is what that's boiling down to. Don't rely on other people for that. And you
Yep.
shouldn't do
How
that
you're going to
anyways.
spend your time for
Right.
what could be a multi-decade retirement.
Yeah,
And
hopefully.
yeah, absolutely. The last point here was you might still need or want to work. And they highlighted here that working in retirement because you want to instead of needing to can be a great pressure release valve for what could be perceived as the boredom of retirement. I'm curious, Jake, do you find in your work with clients that you have more folks that are going back to work in some capacity, maybe in the world today, even versus 5 years ago in retirement?
Absolutely. Yes, I
And so,
think yes. I have a ton of clients that are still working or doing something or volunteering, and just I think they get bored. And I think, there's no shame in going back to work in your 70s or 80s. I mean, it doesn't matter if that's going to, provide you, keep your mind sharp, keep your body sharp because you're getting up and having to go somewhere. A lot of these people though, they're not like chained to a desk,
right.
9 to 5 Monday through Friday, but a lot of my clients are working, or they've got hobbies or volunteer activities that keep them very busy. It's one or the other. Very few of my clients just sit around and do nothing or are very complacent. They're either working still, or they have two homes, or they're with their grandkids all the time, or they're very involved in their church or their community, right? They're doing that, almost is work, right? So it's good. I like that.
Excellent.
Good
Yeah, I thought it
list.
was a good list.
I'm glad you shared it today.
All right. Moving on from that, let's talk about diversification and understanding diversification from conversations with client meetings.
Yeah, two big things. I just posted something on social media about Enron, and it's a horrible story, right? Most people know what happened at Enron, and a lot of the
Right.
employees lost all their money, right? And so I just want to remind people that you don't want to, and a prudent, and again, this isn't a rule for everybody, but a prudent way is that I don't want to see more than 20% of anybody's portfolio in any one investment. And Cory, many times that includes your house, which is a little harder to do for a lot of people. But if you can get your house down to 20% or less of your net worth, that'd be a good place to start also. Because again, not necessarily saying that your house is an investment. However, if your net worth is largely composed
Mm.
of real estate or one house, you're still running a pretty high risk, right? So
Concentrated. Yep.
yeah, if your net worth is $2 million and you live in $1 million house, well, 50% of your net worth is all riding on one asset. And that would be like me putting if somebody had a $2 million stock and bond portfolio, I wouldn't put $1 million in one stock. And so I just want people to understand that. So one, let's not get over concentrated, right? If you want to do real estate, maybe you have multiple properties, but don't let any one of them make up more than 20%. And two, a byproduct of being diversified, and this is actually a pro, it's not a con, it's a pro, is that when you're diversified, at any given moment, you can expect to have assets that are appreciating in value and assets that are depreciating in value, or stocks or bonds that are up and stocks and bonds that are down. But that's the whole point. It's okay. It's okay for that to happen. So those are two big takeaways from that piece I wanted to just share with everyone, is that let's not get more than 20% in any one asset if you can. If you can help it. Some people can't help it, and I get it. But if you can help it, let's do that. And two, understand when you are diversified, you are going to have assets up and down at any given moment, and that's okay. That's the whole point of it.
Just to add to that real quick, Jake, in
Yeah.
fact, if all the companies in your portfolio are moving up or down together, you're not diversified.
Right? You're probably not. Exactly. That's very. I mean, we cheer when that's good, when everything's green and everything's up in your account, but it's very dangerous, right? We like those days, but you have to understand, like, oh no, does that mean if the market crashes, are all of these things going to crash? That's what you got to be careful of.
Yep.
All right, good show, Cory. We got time for, what do you say? Let's do one more. So, Cory, families and businesses would get big tax breaks in bipartisan tax deal. More taxes for us here.
Yeah, more taxes, more tax deals. This one's interesting, though. I've read more about this in 2024. And to make a long story short here, enhanced tax credits for businesses and for families could come soon this year in 2024 under a $78 billion tax framework that's been announced by the Senate Finance Committee and the House Ways and Means Committee. So the Tax Relief for American Families and Workers Act of 2024. I don't know what it is with the names, with all these names and acronyms for these deals, Jake, but the Tax Relief for American Families and Workers Act of 2024 would improve the child tax credit, low-income housing credit, and R&D expensing for companies that are investing and spending money in R&D. And Congress people have interestingly said that the goal is for Congress to pass this legislation in time for families and businesses to benefit during this tax filing season that starts in a week or two, which is a tall order. We'll see how that comes to fruition. But what I found really compelling and interesting about this is that a lot of the sort of stimulus.
Wait a minute, you cut out there. So tax season begins when? What'd you say?
I think the 29th is when people can first begin filing tax returns.
I see. The 29th of when?
January.
Oh yeah. So when this show's out, it'll already be tax season.
Yes.
But how is this going to help? So what are you saying though? Speaking English here. How is this going to help anybody?
Yeah, so that is the reality is that is still up for debate. I don't think that's perfectly clear yet until there's actual legislation that's passed. But the child tax credit, for example, would be a way that folks with children that benefited a lot from that the last few years through some of the pandemic stimulus relief would ultimately qualify for that again. So the bigger point in all of this, in my perspective, and why I wanted to just bring this up, is that I thought it was interesting that there is discussion right now of passing legislation that's going to actually reintroduce some of the more stimulative parts of legislation from the last couple of years through the pandemic. So we'll see how it plays out, but it ultimately reads, and everything that I've followed as far as this goes, is that it is expected to occur very soon, if it does. And
yeah, but I don't see this moving the needle because yes, the tax credit, that's cool, but low income housing credit, good for people that perhaps need that support, but that doesn't move the needle. And then what do I care about companies getting a break on their R&D?
Because it can make their share prices more valuable.
All right, Cory, we like that. Stock's going up.
The same is true for low income housing even. I think the main point there is that if there are tax credits for people in that situation, those are dollars that can ultimately be spent elsewhere. That in a consumer-based
economy, but I think they've done studies on that where people don't actually spend the money. They save it. I don't know.
If they're in a low-income housing situation, maybe not. They may not be in the position to save much. But either way, the point is this legislation could be passed very soon, and it's going to reintroduce some of the more stimulative parts of legislation from Washington, D.C. over the last couple of years, which I just think is interesting. I don't know. I'm sure an election year has something to do with it.
Yeah, I don't know. And with that, we'll ring the money there.
Ring the bell. You know, it's funny, Jake, when you said we have time for one more, I almost was going to say, let's just skip this one and move to the next one. We'll save that for next week.
You chose to put it in the list, Cory, so we're going to talk about it. So good job on that. And we talked about it. So fair enough. Well, thank you again, Cory, as always, for joining me. And thank you all for tuning in and listening. Cory, you got any quick calls to action or takeaways from today's show?
Yeah, quick call to action. Back episode number 243 of Upticks, Jake, you and I interviewed an independent insurance broker. Taking this back to the beginning of the show where we talked about insurance, I would encourage people to go tune into that episode and learn more about what shopping your coverage through an independent agent can look like and some tips and tricks involved were shared in that episode. So 243.
Good one. Yeah. So Upticks episode 243. You can find that in our archives, either on your podcast player or on YouTube. Very good, Cory. And again, my thing is let's embrace, I don't like it any more than you do, but embrace that you're going to pay taxes. And typically, the more money you make, the more you pay. It's just the kind of the way the tax code works. And if you can do proper tax planning, make sure you're not overpaying. The rest is what it is. Right, Cory?
That's right. Civilized society.
That's right. Well, thank you again for joining me. Thank you all for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.